All right, y'all. So we're gonna go ahead and get started. So when one of the main things that I want to do as we go through, I'm gonna let you know what we're doing today. We're gonna go through our agenda. So let me pull this up for you, and I want this other screen. All right, that's the way we're gonna do it today. All right. So now I can share my screen. And if you beautiful folks can give me a thumbs up if you can see my screen. What you got? What you got? Can you see the images on my screen? You should be able to see a tax planning agenda. Can everybody see it? Okay. Hey, Henrietta, how are you?
I
Okay,
can see.
okay, you can see it, Mr. Mills. Great, great.
Hello.
Good to meet you. Good to meet you. And I see we got a home daycare in the mix. So we love the baby. So pleasure to meet you, Henrietta. Uh all right. So today this is pretty much what we'll be going through in the time that we have together. First, just what I'm doing right now. We're going to talk about this intention. I want you to know what we'll be covering. I'm going to talk about some popular tax avoidance cases. We hear about it all the time. People and companies paying quote unquote not paying their share, and it's like, why, if we are some of the lower income earners, or some of the, in some situations, we not the richest of the rich, why are we paying more in percent per our income in taxes? I'll be covering a little bit about a personal financial strategy. Everybody should have their own. This tax planning strategy should support your personal financial strategy. We're going to talk about understanding your taxable income, some important tax ratios to understand when we're talking about tax planning. So, and then we're going to talk about some options for wage earning employees and business earning employees. Lastly, we're going to talk about how we can make tax planning work for you. All right. So if you have any questions, like I said, this is interactive. Take yourself off of mute. I'll go, and I'm more than willing to stop where I am to make sure that we all understand what's going on. Okay. Or if anything, you want to drop something in the chat, then we can take it from there too. All right. So jumping into this. Oh yeah. So what I want to do, the intentions for us coming together, is just to make sure that we're teaching the steps that so people can be proactive in these tax filings. We want everybody to encourage, like, these loopholes that we hear about is not for the wealthy, the top 1%. A lot of these tax loopholes that we hear about, and a lot of them that we don't hear about, we can take advantage too. So I'll be jumping into some of those. And then I want to give some actionable steps to be able to look at, talking about looking at and deploying some of these techniques for our individual tax filings, right? So some tax avoidance cases that you might have heard in the news, you might not have heard in the news. They talk about Jeff Bezos, right? So in 2007 and 2011, Jeff Bezos, he paid no federal income taxes. And this is in the time where his net worth increases, or was about almost $200 billion. So why wouldn't he pay federal taxes when you and I are pretty much paying federal taxes every year? And then they talk about he pretty much claimed on his tax return that he lost more money than he invested. And in both of those years, the report said he paid nothing in those taxes, but he was solely citing those investment losses, right? And if you are an investor, we have choices about what type of losses we want to declare. And then, but at the same time, you look at those things proactively and understanding your tax bill. So I pay taxes every year, or I'm liable to pay taxes every year if somebody is this as much more wealth than I do. I'm curious about what is he doing to save his money, and basically they're having these proactive tax discussions, and they're implementing tax planning. So then we have a couple of other cases. You got FedEx, right? FedEx had federal, they didn't have they zeroed out their federal income tax of $1.2 billion of pre-tax income, but they didn't pay anything. And they even received a rebate, which that means a tax refund. So they got $1.2 billion of income, taxable income, but they pulled certain triggers so they didn't have to pay a dime. They even got money back. They got a rebate of $230 million. Then we got Nike, right, that didn't pay a dime. And all of these are related to 2020. These particular cases here. Nike didn't play anything in 2020, but they had $2.9 billion. And they also ended up leveraging a $100 million tax refund or tax rebate. You got Dish Network, the satellite cable TV provider, paid no taxes, but they had $2.5 billion of income in 2020. Likewise, Salesforce, a CRM platform software, right? They paid nothing in 2020, but they had $2.6 billion of income. Now, what's happening is these companies are evaluating their income as they go through the year, or they have certain projections that they already know that they're going to hit. And then they also start to look at, and what's also most important about tax planning is understanding your industry. So when you understand your industry and you understand some of the tax loopholes that are available, then you can know which ones you can implement. Sometimes we can turn our everyday expenses within our business into what we call credits or tax credits. And that's how a lot of these larger companies get money back. They have things like research and development credits where you can actually get money back from taxes that you paid in, employee retention credits, all of those beautiful things. But that's about knowing their numbers within the current year, being able to implement the strategy, and being able to move forward from there. All right. So these are and this is perfectly legal. These folks are not in trouble. So, but to be able to have an idea about which triggers we can pull, then we talk about these personal financial goals, right? So we all have different goals. And so the tax planning a strategy is just a tool in our arsenal, a part of our overall financial planning, or overall financial goals for our households and for ourselves personally. So most of the questions that I get, or some of the situations that we're usually talking to clients about is, hey, I want to buy a home sometime soon. I'm looking at buying this commercial property. When we know, if you're talking about, if you're going to need some type of mortgage instrument or a loan instrument, then usually they're asking for those tax returns. And so we need to know there's a way you can reach out to mortgage officers, and with your credit report and your income, the amount of debt that's already on your credit report, then we can say they know how much income that you need to show to be able to purchase that asset, get the mortgage to purchase that asset, right? Or get that loan to purchase that asset, just like it might be a vehicle. Some of us might be preparing for retirement. It might not be a retirement sometime soon, even myself, right? I am in my wage earning years. But I know, I have a plan to where one day I don't have to work as actively as I do now. So if I know that I'm planning for that point to where I'm not a day-to-day wage earner or income earner on behalf of my family, there's some things that I can do in regards to retirement that will also affect my taxable liability. So I might want to pull those triggers, and I'm going to talk about that specifically. Likewise, if we're talking about retirement, there's a different tax strategy for if you are already in retirement years and you're trying to preserve your quote unquote nest egg. There are different tax strategies that you want to deploy. So and also reducing the tax bill. If you have a high tax bill, you're a high income earner, you're fed up of giving money to the IRS, then that's a goal of yours. And then so we implement those tax strategies. the appropriate tax strategy. And then we also have family education. So a lot of people, a lot of us, I went to college. Some of us have children that are in college. Some of us have children that are planning to go to college. All of those are tax deductions, tax credits that we can deploy, and also preparing for a child to go to credit. You can be able to fund a college plan pre-tax. So what that means is if you're a wage earning employee, that money can be taken out to go to this college fund and be able to grow without being taxed. So to be able to implement the right tax planning strategy, we must have the right financial goals. Just curious, what about these goals on that we have on the screen? Can we get a thumbs up if anybody on here? Is this one of your goals? Is somebody might have a goal that's not listed here? Just curious, what you got? Anything? Is this in line with what y'all dealing with? Kind of, sorta? No? Okay. What you got? All right. So we got, okay, Miss Trice, you want to buy a home. Got it. Okay. So that's great. All right. So yeah, let's keep going. I just wanted to make sure that I'm giving you what you need, right? And just to let you know, we're talking in the group, right? So I'm talking in principles. So as I go through it, I'm hoping that these principles that I'm explaining be able to apply. My goal is to make sure that it's applicable to each one of us on the call today. So we're gonna go to our next one here. All right. So we have to understand our income. So, and what that means is basically reviewing your tax return. I know we're past the traditional tax filing season. Some of us might need to file before the upcoming deadline of October. So I'm curious, are we actively and proactively looking at the tax return that we filed last year? Like, did you have a tax balance last April, last May, or even in the last few months if you've recently filed? Is that okay with you? Does that support those goals that you already have for your family? So just like Ms. Tracy, if you're talking about buying a home, if you're getting a mortgage, it's a certain income level. So if it's like, okay, you're looking at your previous year's tax return, talking to your mortgage officer, do you have the amount of income to be able to leverage the loan that you need? And that goes across the board. And also being able to claim that amount of income, we're also able to see what do we have to pay, and we can proactively start making payments to pay down bills and getting certain discounts. Okay. Another thing that's very important about tax planning is understanding the income streams and how they are taxed. So when we're taxed as individuals, each type of income is taxed differently. A lot of us are wage earning employees. That means we get a W-2 from the respective company that we work for, and our taxes are taken out of that. And then we have some business owners on the call as well. So we know, depending on how our business is formed, if we are self-employed, we know we have roughly about a 15.3% tax rate, right, for each self-employed endeavor that we have. But then you also have your different, if you're a corporation and you're receiving dividends from that corporation, if you are an investor and you invest in the market, you know that you're receiving dividends or you're having capital gains or short-term gains. Each one of these items are taxed differently. And we have to understand that, because when it's time to make a change, we're like, okay, I need to earn more money. Sometimes earning more money also exposes us to greater expenses. So understanding our goals and understanding the type of income that we have, then we can think about where we need to make a change. Do we need to increase our wages? Do we need to increase our business income? Or is it the business income that we need to decrease? So that is very, very important, because every type of income that we receive as an individual is taxed differently. So understanding that Form 1040 is of high priority. And then we have to make plans for those changes in income. Sometimes as we're going through the year, we might see like, hey, our business is doing far better than it did the year before, right? I know I already had a tax bill. So what are the changes that I can make to, so this new income that I'm making, what's my tax liability? I we got some hands raised here. What we got here? I see Erica, you got a question?
Oh, hey, can you hear me?
I can hear you. How you doing, Erica?
Hey, Cavi. I just had a question. I just wanted to jump in where you said decrease business profits as a way for taxes. I never really heard that. Can you explain that?
Yeah, so that's the common term in regards to what we talk about deductions, right? So there are different ways that we can decrease the respective business taxes. So we're taxed on the income from our business. We're taxed on the income that we earn as wage employees. And as business owners, we have more flexibility to claim certain deductions than sometimes as a wage earning employee. Does that did that answer your question, Erica? We good? Yeah.
Yeah. I'm sorry, I was on mute. Yeah. Okay, so you're basically talking about write-offs.
Yeah, write-offs, deductions. A lot of times we different people call them by different things, but we're talking about deductions um into our business. And I'll be talking a little bit more about some of the changes that business owners can make to reduce that income. Okay. Anybody else got a question before I keep going? I see got two hands. I see Erica. I didn't see another one. I think we straight. All right. All right. So now either your income has changed or you want to change your income. If you want more income, then we also have to prepare for a greater tax liability, right? And if you want less income because you're tired of your tax liability, that's what we talk about, that flexibility for business owners. So we have to understand that. Now, before I go on, I will be remiss if I do not do my not so shameless plug. So if we talk about understanding income, I want to let every one of you know that I have a class coming up, right? So we worked on this class for some time now. One of the biggest things biggest issues that people are overtaxed is because they don't understand their actual individual tax return. It's a lot of misconceptions on it. And so in this class that we'll be releasing next week, it goes line by line in regards to these items on your Form 1040, which is what we are explaining, which the tax planning affects, right? All of this income, the business income, it flows to our individual tax return. So we have to understand it. And some of these terms that I'll be speaking about, we go in much further detail in that masterclass that'll be releasing next week. All right. So as we move on and we want to do our respective tax planning, there are two formulas that we need to keep into consideration. All right, so we have an effective tax rate. The effective tax rate is the percentage of the income an individual or corporation pays in taxes. The effective tax rate for individuals is the average rate at their earned income, such as wages, and unearned income, such as stocks and dividends, are taxed. So basically, you're putting all of these different, that's what I was talking about, as individuals, our income is taxed differently. Our wages are taxed differently from our stocks dividends. Our business income is taxed differently than our wages. So the effective tax rate puts all of that together and gives us a percentage, so we know roughly every dollar that we make, how much of that is going to taxes, right? Then we have our marginal tax rate. What this allows us to understand is as our tax increases, there is a certain percentage of each extra dollar that we earn that will be liable to pay for taxes. So these different tax rates are very important, because if I'm looking at reducing my taxable income, I want to look at my effective tax rate, because if I say I want to reduce my income, my income is less, right? I have 10,000 less of income than I had the previous year. Then I can take that $10,000 to say I have an effective tax rate of 6%. Then my tax bill will be going down roughly 6% at the least. And then you have your marginal tax rate, where if your tax rate goes up, then it's taxed at a particular percentage. And I have a couple of examples to kind of walk those through to kind of bring those concepts home, right? So here's your formula, right? It's pretty simple. This is your effective tax rate. So let's say myself, you see I've been playing around with some numbers here. So let's say as a business owner, right? We got a couple of other folks dropping in. So let's come on in. Welcome, welcome. All right. So let's look at this as a business owner, and we talk about our effective tax rate. So if I say I have a tax bill, let's say I've completed my 2021 tax return, and I had a tax bill of, let's say, $700, just for an example. Say I have a tax bill of $700, but my taxable income for that year was, because we have tax expense divided by our taxable income. Let's say I had $50,000 of taxable income. So what that tells me is that my effective tax rate is 14%. So if I have income of about what did I say, $50,000, a taxable income of about 50, then, and my income goes down by, let's say, $10,000, then respectively my tax bill would go down by that $10,000 by what's 10,000 times 14. Sorry, that answer is 1,400. Sorry. But yeah, so that means my tax bill will go down by $1,400. Now that goes into some different things, and I just use some rough numbers because my tax bill was $700. So if my bill goes down 14, which also means I could possibly get a tax refund. And I go into that in a little bit in depth about how to calculate that tax refund in our class. But that's the idea about using the effective tax rate, by being able to determine it when your tax is going down. Now, when we talk about the marginal tax rate here, and that's the system, we have a marginal tax rate system as here as United States taxpayers, right? So this is our marginal tax rate. Here's an example on the screen. We have a standard deduction of $24,000. And like I said, we talk about this in the master class, right? So that means we have our first $24,000. And I think in this example here, the total income for this particular family is right over 100,000. Let's see. What's that? 19,750. 100. All right. Yeah, it's about 110,000 if you put all of these numbers together, right? So let's say if you have a family that's taxed, has a taxable income of 110,000, that first $24,000 will not be taxed at all. All right. So it's a marginal tax rate. So then we go up, right? This next $19,000 will be taxed at 10%. So if I know I only made $24,000, then I know anything above that is going to be taxed at 10%. So if I make more than these two brackets put together, then anything above that will be taxed at 12%. And it continues to increase. And our government, or the IRS, has a chart, and we refer to it as tax brackets, right? So if you know you've already received roughly about $70,000, then you'll fall in this tax bracket here, to where you have a portion is taxed at 10%, a portion is taxed at 12. Anything above that will be respectively. So if you earn this extra almost $5,000, that extra income will be taxed at a higher rate. Okay. So marginal tax rate is to be able to determine your tax bill when your income is going up. An effective tax rate is what we use when I know I am going to bring my income down and I want to see the difference. Okay. Now I know I'm talking about, I've touched on a lot of different things. Anybody might want me to stop here. Anybody have any questions about what I talked about, effective tax rate and marginal tax rate? We good? Y'all so smart. All right, so I'm gonna keep going. All right, so now our marginal tax rate, this is the system that we live within, and this is how we are taxed as individuals in this United States tax system, right? So we have to understand that. This is just an example of the actual tax brackets that were in place as of 2021. So this is what this looks like, you know, as a real world example that we're dealing with. So if you know, and if you can see, each column is for your respective filing status. So if you are single, and let's say your taxable income came in at about $20,000. So that means you're in this respective tax bracket. Let me get my pointer here. So that means this is your tax bracket, right? As a single individual. And then you will be whatever income it falls in that threshold will be taxed at 12%. Okay. Likewise for each respective filing status. And that filing status changes by the number of people who you're filing on your tax return. Okay. And like I said, we dive into this on the master class for you knowing exactly where we dive into to see why these numbers change. But this is what they call about tax bracket. If you ever, I'm always a big hip hop fan. And Jay-Z talking about, like, when we in different brackets, homie. So that's when you jump down here, and people with higher income, hypothetically, they're being taxed. They should be taxed at roughly about 37%. And then we're talking about people who were income owners of more than $500,000, right? They're getting 37% taxed at 30%. Are depending on where you fall, you might be taxed at 10%. So that's what we talk about marginal tax rate. As your income goes up, respectively, your tax rate will be going up. Okay. Like I said, don't be scared. We here for you. Ask your questions. And then we're gonna keep going. All right. So this is the tax. This is the world that we live in regards to taxes, right? All right. So now an important pieces for tax planning. We hear about it all the time. Erica talked about it. She was talking about the write-offs or tax deductions. And then we also hear terms of where is a tax credit. We have to understand the difference, right? A tax deduction reduces our income. And then we would fall in our respective bracket. So what that means is, so let's look at this here. So let's say, for instance, I'm single and I have taxable income of about $9,000, right? Almost about 10K. I'll be taxed at 12%, right? But if I use a tax deduction for $1,000, I have $1,000 tax deduction, that will bring me down to this respective bracket. So instead of being taxed at 12%, I'm taxed at 10% because of my $1,000 tax deduction. Okay. So a deduction decreases income, which has the potential to decrease our tax rate or decrease the amount of money that we are taxed on. That's what we talk about, the tax deduction. Now, when we talk about a tax credit, so a credit is a dollar for dollar credit to your account. And this is not towards your income. This is towards your tax balance. So think, so let's think about like a tax deduction is like a discount code. Somebody gave you a 15% discount, but a tax credit is almost like an actual credit on your account. Let's say like, hey, they credited your account, so you get that item, whatever you purchase, is coming to you for free. Not based off a particular percentage. So what does that mean? So a tax credit will, if you have a tax bill of $1,000, you receive a tax credit for $800. That does nothing to your income, but it does pay your tax bill. So your $1,000 tax bill with an $800 credit, now your tax bill is $200. So credits are always more effective when we talk about decreasing our tax bill, because it doesn't change our income, but it does pay the actual tax balance. Okay. And then when we start considering tax deductions and tax credits, we have to also understand that I think it's a video that I that's floating around social media right now that I really, really like, and it explains it well, is that the tax system is an incentivized system. The government gives us decreases on certain taxes if we participate in certain functions that they like, or that they approve of, for lack of a better term. So like in boosting the economy, transacting money from individual to individual, person to person, that boosts our economy, right? The government wants that. So that's why business owners have so many options for tax deductions, because they want us to continue to spend this money, right? Or tax credits. And likewise, even as individuals, we have to think about, okay, we get credits for the children that we have in our household. Our government grows because our families are growing, right? So that's a benefit to the government. Or people being educated. They want an educated population, so they're going to give you a credit for going to school. Just different things of that nature. But so you got to really, energy reduction, Energy Star pieces, these implementations, these are credits, and these can pay our tax bill. So let's say if we install a solar panel, then a portion of that we can possibly, or some solar friendly windows, then we can end up getting like a $500 credit, which pays our tax bill. So tax deduction, tax credit. Tax deduction is a discount. Tax credit actually pays your tax bill. And like I said, we dive into that in greater detail in our masterclass for individuals for next week. So make sure you check that out, and you can jump on the waiting list so you can be notified when that does drop. All right. So we're talking about tax planning. These are the many colorful options that we have for wage earning employees. The most important thing that you need to know for tax planning and the options for wage earners is not many options to increase taxable income as a wage earning employee. And you might need more income if you are trying to get that home mortgage. If you are trying to purchase that commercial property, you need to show a certain amount of income. So as a typical wage earning employee, you don't have many options in that arena. Now, this list that we have here, these are all, as you can see, we have credits listed here. We have deductions listed here. So we got our child tax credit. You get it roughly about $1,500 to $2,000 per child within that particular age range. You can also, if you are taking care of, not only do you get credits for children, if you have a dependent to where they may be an adult and you're actually taking care of them, you can get a credit for that too, but this is more like elderly care. This person, this is not just a able-bodied adult. You have the earned income tax credit, which is just a credit solely based off the amount of income that you've earned, which the government supports, right? They want us to be wage earning employees. They want us to participate in the economy. You can get charitable deductions, which you can make charitable donations where you get a deduction. So all of these, I'm gonna stick on the credits for first time, because like I said, the credits are the most valuable. So we have the American Opportunity Credit. That's the credit where people go to college for 4 years. If you have a college aged student in your family or in your tax return, you can use that, and that is a credit to pay your bill. You have the lifetime learning credit. A lot of people don't hear about this. They hear about the American Opportunity about school and college, but the lifetime learning credit is regardless of whether you're in college or not. But with whatever that you're learning, you can use the expenses for what you learned and use that as a credit on your tax return. Let's see some other credits that are here. We have our savers credit. There is a very specific credit to where if you are donating to your retirement, once again, like I said, the government wants you to fund your retirement because of the whole Social Security fiasco, right? You receive a credit for a certain amount. I think about up to $2,000. You can be credited to your tax return solely by contributing to your own retirement funding. We have the residential energy credit. So let's say that you are putting on, let me charge this up real fast. I'm over here working, and we don't want this to die. Give me one quick second. All right. There we go. All right. So yeah, our residential energy credit. So if you are making household improvements, if you are concerned about the environment, you can get solar panels, you can put windows on your home. These items, which the government supports, they help pay your tax bill and reduce your tax bill. And then we also have the recovery rebate credit, which has been new, where people have getting the stimulus payments and even the advanced child tax credits. So people are receiving that ahead of time. So the deductions on this list, right? Student loans, they want you to pay your student loans. That's a deduction. Think about that as a coupon. Your charitable deductions, medical expenses, this whole line here, minus the second line of deductions, minus the earned income credit, all of these deductions are what we call itemized deductions, right? So like I said, I dive into that a little bit in depth in our class about these different deductions. Basically, your itemized deductions, the IRS gives you about $12,000 per person. So, but if you can take these deductions, your charitable deductions, medical expenses, local taxes, in mortgage interest, even losses for legal losses for gambling, you can put that together. If it's greater than your standard deduction, we can use this to decrease your income. Like I said, 401k contributions, health savings accounts, this is a deduction. Self-employed expenses, that is a deduction. Home office deduction, to where you're using a portion of your house for your business, we can use that to reduce it. The most important thing is the financial strategy, your personal strategy. It's not about trying to implement all of these. It's about understanding what's important for your household, and then knowing where you are in your household and implementing those things. And then you can pick and choose the ones that apply to your life. Not just because sometimes it's not about just, oh, this is the thing. I'm gonna do all of it. No, it's about what supports your lifestyle. These are options, right? These are just options. So these are the options for our wage earning employees. Now, we talk about tax planning options for business owners. Now, these options for business owners, we're talking about pretty advanced strategies. Number one is very important to note where I say all personal options, because every business owner has to file a personal tax return. Depending on, yeah, pretty much to keep it as simple as possible. We all will have a personal tax return. So all of the options on our previous screen, because we are individuals, we still have those options. And then you get bonus options as a business owner. Like I said, the tax system is an incentivized system. So you get this and that as an option if we're talking about being business owners, right? Okay, so all business related expenses. These this is everything, every expense, every dollar that you spend for your business is a deduction. Erica, you hinted at that earlier today. One of my favorite plays, well, let me back up a little bit. So these options for business owners, this is a bonus on top of the personal tax, the personal options, excuse me. These tax planning options for business owners are bonus items in addition to the personal options, right? Because and a key thing about these business owner deductions or credits is we have to remember that sometimes they call for actual cash outlay. What that means is to deploy this particular deduction or credit, I have to pay something. Money has to move. However, there are some credits, there are some deductions to where no money have left leaves our bank accounts, no money leaves our pockets. It's truly or solely a paper effect, or it's only a paper trail, right? One of those things is depreciation. Depreciation is the reduction of value of a particular asset that lasts longer than a year. Most of your assets that fall in this category might be some type of machinery that's more than $2,500. The most popular assets that are depreciated are vehicles. Regardless of the size, you can depreciate them. That once you get them to that over the $6,000, 6,000 pound gross vehicle weight, then you can depreciate it 100% in 1 year. Then you also have so depreciation is solely a valuation thing. So if I have a vehicle, then I have I can use that depreciation expense to minimize my business income without going to purchase another vehicle, right? So now, but if I say I want to hire my children to reduce my taxable income, now that is a play that cash actually has to move. That is not paperwork. It's paperwork in addition to cash management. That money has to go to your child's account. It can be a savings account. It can be these different investment vehicles, but it has to be in the name of your child. It has to leave your business account. This is not something that we have to solely do on paper. All right. So that's why I said we talk a lot about these strategies, but we also have to understand that some of them, to be employed properly, also demand that we move a certain amount of money. All right. This next one is one that I really like, is the SEP retirement contribution. SEP stands for a self-employed retirement plan, right? What this means is as a small business owner, I can use the profits of my business and put that directly into my retirement account. It has to go into my retirement account. Like I said, this is another cash outlay. But one of the beautiful things about it is that you can use this particular deduction up to $57,000. And honestly, it changes year after year, but it's more than $50,000. So let's say you have a business that your business's profit is $70,000, right? Your business is about to be taxed on $70,000. You have cash in the bank. You are in the situation to where you are preparing for retirement. So what that means is I can take my cash out of the bank, and I can go to I can go to I can put this money into my retirement account, which is a part of my profit. So if I'm saying I have a profit of 70, let's say I've had $50,000 that I can spare and put into my retirement account. My business will only be taxed on $20,000. And my retirement has been funded and had, by 50K, which now is also growing tax-free. So that's where I talk about like these advanced strategies. We talk about ones, depreciation is one to where there is no cash outlay, but there are others like hiring our children, the retirement contribution to where we actually have to put money there. Now, research and development credits, like I said, credits are more valuable, but and this also the domestic production activity deduction. These are two types of credits and deductions that mean, first, that in terms of research and development is basically that we can recategorize some of our business expenses to qualify for a credit. Research and development credits means that this is a technology company that is improving its services, improving its offerings, and that it has paid its W-2 employees solely to improve a product, solely to create a brand new product. And it's for tests, a very specific test, but this can be in the course of everyday business. But once it's designated as a research and development activity, we can use that particular activity as a part of everyday business and get an extra credit. A lot of these businesses have done it where I mentioned like FedEx, Amazon at the beginning of our time together. Some of these people have deployed research and development credits to get money back from their tax bill, which is, like I said, once again, with that earlier in the day where I was talking about these large taxable incomes, and they still have a tax refund. But it's because they use a particular tax credit or refundable tax credit, which we go into in detail in our masterclass. The domestic product production activity deduction is a tongue twister. Once again, taxes is an incentivized system. This particular deduction is for anybody who is in the manufacturing industry and you have W-2 employees. I'm pretty sure if you follow the news cycles for the last few years, for more than a few years, a lot of our manufacturing jobs have been moved overseas. So if you have a manufacturing type business, a manufacturing operation, you can use a portion of the W-2 salaries that you pay your employees as a part of everyday business. Then you can get an extra deduction because you are not outsourcing labor. You're keeping that on the U.S. soil, and for doing that and for creating jobs, just like the government wants you to, you are rewarded. And this one I'm very excited about and passionate about is what we know as opportunity funds, or it's called opportunity funds. Opportunity funds is a term that was introduced in 2017 in the Tax Cut Jobs Act that was moved forward or made law during the term of President Trump. It's a very detailed item. This does mean that money, cash has to be moved, but I definitely recommend anybody to research it, because if you see it, you have opportunity funds and you have opportunity zones. What this means is businesses and business owners who have profited from one particular business or profited from the sale of an asset, whether that might be a house, the sale of a business, whatever it is, it's a capital gain, the sale of a particular amount of assets, securities, on whether that might be stock or something, excuse me. So that the profit from that capital gain can be moved in what's called the opportunity fund. An opportunity fund must be located in the opportunity zone. What that allows the business owner to do is to defer the total profits of that particular sale of that capital asset. That total capital gain will be deferred until that business owner takes it out of the opportunity fund and opportunity zone. This is I really recommend that you look into it, because opportunity zones, and this is me on my soapbox, it really has a to do with gentrification, or these opportunity zones. These are when you look at them, and you can find them on the internet. These maps are they highlight the areas that are opportunity zones. So, but that means if somebody sells, let's say Trump, right, sells one of his towers, he has a capital gain of $2 million. He can take that whole $2 million, put it into an opportunity fund, let it grow in the opportunity zone area, and receive tax benefits, tax income, and not be taxed on the money that he reinvested into an opportunity zone. Look at those opportunity zones wherever you are in the US. You will see whatever city that you look up, you'll see these are cities that are in areas that are plagued with quote unquote redevelopment, regentrification, displacement, things of that nature. So it's something that I've been looking at for a while, and I'll be talking more about it. But that's a play that we can do as business owners, and we can use it ethically. And it's not talked about enough in our communities. And it's a very special thing, and it's valid until 2026, unless until they change the law. But look up opportunity funds. It's another play for business owners, right? All right, I said a lot. Questions, thoughts, comments? What you got? I see the profits of the actual investing in the opportunity zone is tax-free. The profits gained from the initial profit, right? So Erica, I know, let's say I invest in a particular property, right? I've owned this property for some time. I sell it, I get a gain on this property. Let's say I had a huge gain, I've redeveloped it. I'm talking about I got a gain of maybe $100,000, right? From flipping the property, flipping the home, whatever it is, just it's a huge amount of, it has to be a capital gain, right? That's the most important piece. And you take that capital gain, you will be taxed on a portion of that capital gain, but it's that initial capital gain that you are not taxed on. You reinvest it into an opportunity zone, you grow it again, and it grows. That initial $100,000, it'll grow in there tax-free until you pull it out. If you leave it in there for up to more than, I think it's 10 years, if you leave it in there for longer than that amount of period and it continues to grow, you'll never be taxed on that money. So yeah, it's a play that it has to be investigated. Make sure it deals with capital assets. But it's a huge benefit, and it's big for, like when I said earlier about knowing your industry and knowing what's applicable to your industry. That might be a huge play for someone who is an investor, who is in a real estate investor, or even a stock market investor, if they have that large amount of capital gains that they've been holding for years. This also can happen for people who've held property. Some people inherit property from their parents, then they have it, it's a capital asset, then they sell it, then they have this huge tax bill, but they didn't determine what they wanted to do beforehand. They could have reinvested it and mitigated that tax bill. And there's so many other plays that's not listed here. But the key to it all is about understanding your industry, being proactive, and pulling the right triggers before the particular deadline. All right. Erica, I hope that was helpful. Please let me know. Give me a thumbs up if that helped you out. But the root of it, and we talk about implementing any of this, then we talk about how we can make tax planning work for us, right? So it's 6 steps, right? All right, cool, Eric. I'm glad I helped. So first, we gotta establish those household goals. We have to have those plans for our family, for our spaces, so we know exactly what we need to do. Right, that's our first piece. Um, then we have to learn how these tax filings that we use, learn how our tax filings affect these specific particular goals. So whatever your goal is, your tax filing should be a part of it, or understand how your tax filing will support it, right? And then if it doesn't, then that means we have to make a change. We have to make a different plan. All right. So then we have to understand these tax returns. We need to know how we're being taxed. What triggers can we pull? Sometimes it's not about changing the greatest amount of income. It's about we might have some optional credits that we can employ. Let's look at those credits, but like let's look at our tax return and understand it, and because our tax return is a representation of financial transactions that happen over a given calendar year. By understanding that tax return and understanding our lifestyles, our life changes, then we can be like, okay, um, I know I got another baby on the way, that's going to increase my standard deduction for my family. That's going to increase some exemptions, and I got a new credit, okay, I can claim more income, just all of those different things. But whatever the situation is for you, you have to be able to understand the previous year tax return, understand the changes that's happening in your life, and then it's a formula, we can put it in. So then we also think about those changes that's needed, right? Sometimes, like I said, it might be a cash outlay. It might be just a paper trail. If it's just a paper trail, it's a little bit easier. If there is a cash outlay, you have to be able to evaluate that the cost is greater than the benefit. And so just because it reduces your tax bill, we might not it really depends on if you need to make that purchase or make that or disperse that cash, because you might need that cash on hand. It might be more valuable to you on hand. And it might be, oh, if I know I can depreciate, if I can get 100% on the vehicle depreciation, but I don't need another vehicle, it might not be the wise decision, or I might need a tractor or a bulldozer for my business. Okay, then I can go buy that vehicle. I can go invest in the asset because this is something that I need, and it pulls a track. It has an effect on our tax return. So it should be able to support your goal and have the need that you want, or achieve the need that you reach that goal, whatever, it has to be aligned. Don't just do it because, oh, it was on the list because it's going to reduce my tax bill. Reducing the tax bill is not always the best thing. Then we got to have the dollar for dollar calculating those monetary changes and how much it is going to bring down our bill or increase our bill. Then we can look at those effective tax rates, those marginal tax rates, and then we have those formulas to be able to pull the trigger. Lastly, we just got to execute the plan. Sometimes we gather a lot of knowledge, and I'm talking about myself too. We have to make sure that when we're gathering knowledge, that we also have time set aside to be able to implement it, have the capacity to implement it in whichever way. A lot of times we can implement it. Sometimes we just need help, in implementing those plays, those changes that will affect us, that will align with our goals. Believe me, I know myself, because I know some of y'all on here help me, and I'm ever so grateful in executing the plan. So it's about that, right? And I want to let you know that I want to make myself, the purpose of doing this and having this time today is to be able to make myself available, to make the resources of our firm available. And I know at times that this can be quite daunting, if you will, in regards to the amount of calculations that might be needed to understand which plan is effective for you. I know I gave her a lot of information in there in this presentation, along with some calculations. So you got some homework. Um, Everybody that has RSVP will receive this recording, will receive this presentation. I would like you to review your previous year tax return, review your family's goals, think about what you need to do for your family and for your business, and think about how your tax return supports that. Then we can start pulling these triggers. You can look at this list of deductions and credits. Google is your friend. See what Google, the IRS website, it'll tell you what you need to qualify for each and every one of these. If you need some help, we are here to help you. We do tax planning. Usually when we have tax plans, when we do it as a consultation, we have our hourly rate. And our hourly rate usually for anybody just walking off the street is usually like $175 per hour. For anybody who participated in our class today, participated in this webinar, you reach out, you need help with your tax plan, we'll make an estimated amount of time that we'll be able to support you, or the type of support in analyzing your particular situation. We'll let you know, and our hourly rate will be decreased or discounted. You'll get a deduction or a discount code for roughly 37% off our hourly rate to be able to help you implement these tax plans. All right. So by reducing it by, I use 37 because that's the highest amount of our tax bracket in the U.S. system, right? And since we bring in taxes down, and I know we got some high wage earning wage earners and business owners, you know, who will be soon hitting that 37% tax bracket. I thought I'll just to put that in into the universe. We're gonna put that 37%. We'll give you a 37% discount on any tax planning services or consultation that you need from our firm. Just mention this presentation, say you were intended, you RSVP'd, and we'll get you squared away. Other than that, we're here to help, and we're here to inform and empower. And I hope this time today did exactly that. We're roughly at our time, or really we overtime. So I'm curious what y'all think. Any questions? Don't be shy. I swear I won't bite. I'm friendly. But yeah, questions, thoughts? Was it helpful? Anything? You can take yourself off mute. You can put it on chat. What you got? Anybody? Y'all cool? All right. Going once, going twice, 3 times. Well, I want to thank you all for attending our very first tax planning webinar. We are available. Please, if you do have some questions, email them over. I'm excited to be able to help. I want people to be proactive in their tax planning, in their tax filing. I'm really grateful that you took the time. I know you can be anywhere in the world, but y'all decided to hang out with us on the Thursday night. And with this very, very exciting information. My goal is for it to put some money back in your pockets, or to help you achieve some of those financial goals. So as we come to an end, I bid you all a wonderful evening. Tip my hat to you, and you just reach out when you all are ready. We'll be sending out this replay, so you have access to it. And we'll also have it posted on our website, YouTube, all of that good stuff. So you can keep, especially people within our inner circle, can have this as a resource and help guide them along their financial literacy process and journeys. All right, y'all. All right, Henrietta, Erica, Aya, Sharice, Cosetta, Candace, all of that. I think Kool-Aid was on here, Mr. Mills. Man, appreciate y'all. Y'all have a good night. Rest well. I look forward to talking with y'all soon. All right. Bye.